assistance. You can either send a message to us via the Q&A box at the bottom right, or you can call WebEx tech support. For those who are on the phone but can't connect to WebEx, I will read that number. 1-916-229-3239 from other countries, 1-866-229-3239 in the U.S. and Canada. If you listen through your computer audio or headset and experience technical difficulties, simply press stop for a few seconds and then press play once again. That usually takes care of it. Or you can join the teleconference. Web seminars are enhanced by your participation, and we encourage you to submit them through the Q&A box on the right. Our panelists will answer them in the order in which he is able to. Simply type in your question and press send. Every attendee today will receive 1 ACAMS credit per hour of instruction that is automatic in your system, and you don't need to request it. If you are seeking a continuing education credit from another granting organization, you will need to contact them. Very good. Now let's get started. It's noon. Welcome to the ACAMS web seminar, Changing the AML Game from Reporting to Rejecting Suspicions. My name is Greg Fields, and I'm Training Manager for ACAMS. Today's webinar is sponsored by Fiserv. Fiserv is a leading global provider of information management and electronic commerce systems for the financial services industry, providing integrated technology and services that create value and results for its clients. Financial crime risk management from Fiserv provides an enterprise financial crime risk detection and remediation solution that protects customers and customers' customers from financial crime. Specializing in AML, check fraud, and electronic payments fraud prevention and customer risk. Financial crime risk management is used by more than 1,200 financial services companies across 70 countries. Our presenter today is Jeroen Dekker. I hope I pronounced that right, Jeroen. Jeroen is Product Manager, Financial Crime Risk Management for Fiserv. He has global product management responsibility for the financial risk management platform and its AML Manager solution at Fiserv. He's been a guest with us before, having hosted an ACAMS webinar last year, and I'd now like to turn the podium over to him. Welcome.
All right. Thank you, Greg, and thank you, ACAMS, for having me again. Hello, everyone, and thank you for joining me in such large numbers today. I am, as you can see in the picture there, I am based in the Netherlands, where I live and work, country of flower belts and windmills. Where it is 6 p.m. right now, so hopefully that means that my boss will pay me for overtime for doing this presentation right now. My boss would indeed be Fiserv, about a 20,000 people company serving the financial industry with technology solutions in various ways, and one of our businesses is indeed financial crime risk management, where I have responsibility for the compliance solutions that it brings on its platform. And at the heart of that platform is behavioral monitoring, or transaction monitoring, as the industry often calls it, which is essentially figuring out when a client's behavior becomes so unusual that it warrants investigations, as that screenshot illustrates right there. So welcome all. Today's topic is about the use or uses of real-time behavioral monitoring in the AML space. That is not a wholesale plea or recommendation to move everything over to real time, but rather it is a number of observations and questions and experiences that I'd like to share with you through this agenda that I had in mind. So what I first want to do is walk through financial crime as it's fought today on different fronts and how the industry thinks about prevention versus detection after the fact and reporting. After that, I'll also have just some questions and observations about the way AML regulations are defined today. After which, I'll harvest some things I've seen in the field in recent years that call for the use of or even already act in real time in the AML space to detect things. After that, I'll share some thoughts and observations on if you were to move to a real-time detection approach, what are some of the things that you need to consider? And then the last topic is just, given all of that stuff, is it worth thinking about a wholesale shift in approach and just some thoughts on that. Hopefully that leaves some time at the end for Q&A, where I'll indeed pick from the questions you're sending in and try and answer them. And the ones I won't get to, I'll try and answer them offline if contact details permit me. So an overview of some policies and paradigm across sort of the financial crime spectrum. As you see here in the blue boxes, I've listed the various types of financial crime that have been, well, top of mind, I guess, for the financial industry especially. And starting on the left there with the sanctions space and the sort of political sanctions, embargoes against entities, the paradigm clearly is to, by and large, prevent violations from happening, right? Performing a transaction for a sanctioned individual on the OFAC list, for example, is a crime and you should prevent it from happening. So pretty cut and dried, right? There's obviously exceptions, right? You can do certain business with Iran if you get exemptions from your regulator, but by and large, if it's illegal, you need to stop it. Of course, closely tied to that, given their appearance on sanctions lists, is the world of terrorist financing, where if they're known and sanctioned terrorists, your job, just like in other types of sanctions, is to prevent holding funds or executing transactions for them. However, there's a bit of a blurred line there, because if you stumble onto transactions that may be used to further terrorism by or for people that aren't on a sanction list, your job most likely is to just report that to your regulator or to law enforcement, but let them go in order to not tip them off, right? If in the United States, for example, a 314A list comes in that asks you to look for people, some of whom might be terrorists, your job is also just to look for it and report what you find instead of trying to stop anything. In the corruption and bribery space, of course, a domain that's become more prevalent in recent years through the activity around the FCPA in the US and the UK Bribery Act. Insofar as your own organization's potential involvement in corruption and bribery is concerned, the UK Bribery Act, for example, clearly talks about prevention, right, in the way it phrases its regulation. And in fact, if after the fact some corruption or bribery has happened, having appropriate measures in place to prevent it would actually constitute a viable defense potentially. So by and large, also a prevention paradigm. And that's where it stops for a little bit as we move into tax evasion. Now, clearly, I'm talking here about tax evasion by your clients without you willingly helping them, because the latter obviously is a crime that your organization should try and prevent. But I'm talking here about things like tax evasion having become a predicate offense to money laundering, and it is not your job to go and figure out the predicate offense to money laundering, right? Your job is just to report the outcome, that being money laundering. And also FATCA, right, which is largely just an observe and report paradigm, right? Go find U.S. taxpayers and report them if they have enough money to be interesting to the IRS. And that takes us to, well, the heart of today's topic, which is money laundering, where as an industry, by and large, the paradigm is observe and report. And my focus here today is primarily on monitoring clients and their transactional behavior throughout the course of the relationship, right? If you find something suspicious, report it and carry on. And I'll obviously dig into that after this slide. And the last one on this list then is fraud, where obviously if it's serious fraud, you do have an obligation to also report that to your regulator in many countries, but your mandate and your what you're able to do and what you logically try and do in the fraud space is to prevent losses from happening, right? Prevent people from stealing money from your customers or your institution itself. So overall, money laundering, an observe and report after the fact paradigm. Except in a country like, for example, Latvia, right, the Eastern European country, where at least since 2009, part of their AML law looked something like the two excerpts you see on the screen here. And you don't have to read through them. I'll try and summarize. Basically, it says, if you think it's suspicious, you should stop the transaction, or halt the transaction at least, report it to your regulator straight away, your FIU, who will quite quickly return with a verdict of saying, let it go or stop it. And you can then notify the customer in writing that you're doing so. So that's an interesting approach, I find, and one that seems rather different from what's policy in most countries. One can only speculate as to the reasons for it, but it could be that they just decide to take the bad guys head on, right? It's obviously a region that has its challenges with financial crime. In fact, I was presenting at a conference in the Baltics several years ago on financial crime, where a bunch of banks were present, not just from that region, but also big system banks from the U.S., and some U.S. regulators were present. And the undertone a little bit was for the region to show that it was doing enough to combat financial crime. So apparently that turned into a policy where they just decide if it's suspicious, we're going to just say no to that client and prevent the bank from moving that money. So I haven't spent a lot of time trying to find if there's other countries that follow the same approach, but I found it to be an interesting example nonetheless. So if you look at the global policy around this stuff, it's worth digging into how, for example, the FATF recommendations on CDD are constructed. Most of you, ACAMS certified, that most of you are, probably know this stuff by heart, but if you recall, there are sort of four parts to CDD, mostly around onboarding. And then there's this fourth one, number D, that talks about ongoing due diligence and scrutinizing transactions throughout the relationship to ensure that those transactions are consistent with how you would expect that customer to behave. So that's several things in one paragraph, but that's number D over there. After which, the recommendation goes on to say that if you're unable to complete those, including D, you should not open the account and or also not perform the transaction. So that's worth asking, what exactly constitutes an inability to complete that paragraph D over there? Which takes me to the next slide, hopefully. Yeah. So you should stop transactions or not perform them if you're unable to complete D. Now, what does that mean? And it's an open question. I don't really have an answer. Does it mean you should stop transactions for a client or a walk-in customer if you're unable to monitor or scrutinize them? Well, that's probably a clear yes, right? You need to have an AML program, so you should have an ability to monitor them. Or if you are able to scrutinize them, but you are unable to decide whether or not those transactions or that particular transaction is actually in line with what we would expect from this customer. So you're able to look at it, but you cannot quite figure it out. Does that mean that you need to stop the transaction? Or is it the third one? Yes, we are able to figure out whether or not it's in line, and we find out, no, it is not in line with how we would expect this customer to behave. In fact, it is suspicious, and it's probably money laundering. Now, I think the paradigm is that you then supposed to file a SAR and report it to your regulator and let the transactions go. And something sort of itches me about that, right? That if you are able to get through the whole process, only to come to the final conclusion, aha, it's probably money laundering, only then can you let the transactions go. There seems something a little weird about that. So it seems that you could define that a bit more articulate in the regulations. Because the outcome of that then is that you let the transactions go while reporting them and submitting to your regulator while thinking it's money laundering, which then allows the bad guys to buy places like this. And while society hopes that law enforcement is able to at some point catch them using their street investigations and then aided by the financial intelligence that we as an industry provide to the FIUs. So it starts begging questions about what the words prevent and mitigate that are pervasive throughout AML regulations really mean. I read a book a couple of months ago about a situation that happened in Holland somewhere between 10 and 20 years ago, where Amsterdam in particular got rocked by a number of liquidations in the criminal world. Some clear bad guys, but also some lawyers and real estate investors got murdered. And over time, a lot of investigation happened, and it obviously turned out that they were all drug kingpins or related to drug kingpins, and they for sure did a lot of money laundering. And as it happened, the money laundering method of choice was real estate, right? So they would go off and buy houses like this to stash their money, right? And the house would be in the name of a trust in a tax haven somewhere, and all very unclear. And the bank's sort of like, we're not quite sure if that makes sense, but maybe we'll report it and then we'll let it go. So it took quite a while for that whole scheme to unravel. One could wonder if it didn't become such a high-profile situation of a lot of people being killed on the streets of Amsterdam, whether they would ever have to give up these houses had they survived. What's interesting about it is that whole situation in Holland resulted, from a law enforcement perspective, in a shift in the burden of proof against suspected money launderers. Instead of the state having to prove that someone's money was derived from illegal means, from crime, from predicate offenses, the burden of proof is on the suspect or the consumer, if you will, to prove that their money is obtained legitimately, right? So in Holland, tax structures are such that, the government knows what I make with Fiserv, and so it has some sense of my income. So if they see a lot more money, the burden is on me to prove that that's legal income as well. And if I cannot prove that, they can seize it if they're involved in an investigation against you. So again, these words prevention and mitigation, it sort of says if you as a bank cannot mitigate the risk of money laundering, you can exit the relationship. So that begs the question, what's then mitigation if you think it's a bad guy? Is that just report and keep reporting and move on, right? Report everything the guy does, or is that then enough to say I'll exit the relationship if I really think it's a bad guy? Here's just another example of, well, basically the FATF recommendations translated pretty much straight on into a local AML regulation. This is an excerpt from the AML regulation in Singapore called Mass Notice 626. And it basically says the same thing, right? If you're unable to complete CDD, including ensuring that someone's behavior is in line with what you'd expect, you should terminate the business relationship and then figure out if it's suspicious and file an STR. So it's not just sort of the high level FATF recommendation. You see this translated on local level as well. So with that, I'll turn to some use cases I have seen in recent years with our client base for the use of real-time detection, if not prevention, in anti-money laundering space within the current sort of regulatory structure and paradigms. So several weeks ago, we, Fiserv, had one of our user conferences for our financial crime risk management business. This one was in London, where a number of European clients gathered, and some of those were from the Mediterranean. And so we talked about a lot of stuff, and one of those topics was sort of maybe in preparation for this webinar, to talk about potential use of real-time detection in the AML space. And one of the very concrete example that a client from the Mediterranean told us about, like real life use cases that are really happening in his business, is that a probable money launderer walks into a branch and tries to make a large deposit, or for example get a large loan, which will then later pay back with bad money, right? And he would tell a story that, for example, he has a scrap metal business, or he sold a scrap metal business and he has a bunch of money, etc. And the vigilant teller at that branch would not trust it and would send him away. Okay. Now, in cities, it's pretty easy for such a guy to then get in his car and drive to the next branch and try again over there, but with a different story, right? And there's real examples of this happening, where at the next branch it was about an inheritance, and at the next branch it'd be a different story. And so the gentleman from his bank said it would be really useful if a system would allow us to immediately have that lady from the first branch or the guy from the first branch enter some data and fire that off across all the branches, right, as well as compliance immediately, so that it puts all of those branches on alert that this guy might come in with a story trying to deposit $200,000 in cash, for example, with some story, right? So it's a real tangible, practical use case of wanting to know about stuff in real time across your institution, instead of the next day in compliance only. He, by the way, had more interesting tales about money laundering in that region, ranging from oil coming in from Libya on the high seas in the Mediterranean to meat importers from Brazil that hide their drugs in that meat. So that's one example. The other comes from the United States, where, of course, for decades, banks have had to aggregate their cash transactions to see if a CTR is required. But obviously, a lot has been happening in the financial industry, and you see all of these new players coming up in the payment space that come out with new value instruments, such as prepaid cards in this example. So what one of our clients is a vendor in that space, right? They are a payment processor, prepaid cards, and they have a whole network of retail outlets, right, where people can walk in and either put cash onto their card or withdraw value from that card back into cash, right? And both of those constitute cash transactions for U.S. BSA AML purposes. And so what they needed is real-time aggregation of that stuff. Essentially a similar use case as the previous one, only this time someone walks into outlet number one, right? And these aren't bank branches, right? These are maybe your pharmacies and those kinds of things, where that support this type of prepaid card. And he deposits $6,000 or $2,000, whatever the case may be, and throughout the day he does that from outlet to outlet. And it's the one that where the aggregate goes across 10,000, that where a bell needs to ring to make the outlet ask the person for their identification details as required on CTR. So they've taken to use the technology of real-time behavioral monitoring and aggregation on card level and or account level and or client level to identify CTRs happening or more than 10K in cash happening, so that they can fulfill their identification duties at the right outlet. The next one is perhaps the more interesting one. I also heard about this at another one of our youth conferences, this one in Paris, where we had a congregation of French-speaking clients, where I wasn't of much use because I don't speak French too well, but that's beside the point. But I again broached this topic of real-time AML detection, perhaps to prevent transactions from happening. And lo and behold, at least two of those clients said, yeah, we do that today. We do that today. If we look at transactions before they're executed, and if we don't trust it, we don't execute the transaction. Now, this probably isn't about your $100 ATM withdrawal, right? This is about large individual business transactions, either for rich individuals or for businesses, where those banks say, if we really don't trust it, we won't do it. So I asked, isn't that sort of in conflict with the policy objectives of your FIU, right? Which is to receive intelligence about those things and let those things go so that they can start monitoring that client, and it might come handy in an investigation at one point in time. They said, yes, but we're also beholden to our prudential regulator, like the central bank, who want us to follow a different paradigm, and that is to avoid risk. And why do they say that? Well, that's because their job is to protect the reputation and stability of their members, but also their financial system as a whole. And obviously, in Europe, there have been some high-profile situations in recent years where banks got it wrong, and that, of course, put the dent into exactly that, their reputation and stability. So these banks have to sort of juggle between, on the one hand, their AML regulatory direct obligation to follow this observe and report paradigm towards their FIU to aid law enforcement, but on the other hand, and sometimes decide to just say no to just avoid the risk, right? Because their prudential regulators say, just don't get involved, just stay out of it, okay? And that, to me, was rather interesting, but at the very least, having the ability to detect suspicions in real time before you execute things is a useful capability to have to at least consider what to do, okay? You should probably still, in each of those situations, consult with your legal counsel to see what would happen if you reject a transaction, what are your contractual obligations towards the client, what would happen if you let it go, etc. But clearly they have taken to at least understanding before executing, which is interesting. So, which is probably related to this topic that's been kind of big and important over the last year or so, and that is the idea of de-risking, where large institutions in particular have taken to stop doing business with whole classes of clients. For example, money services business, or politically exposed persons, or they would quit their correspondent banking business. And earlier in the year, regulators like the U.S. regulator FinCEN and the FCA in the U.K. Sort of spoke out against that practice, right? They said, don't de-risk classes of clients de-risk individual cases. And the recent FedEx position that came out last month, in fact, sort of takes a similar stance, right? Don't de-risk whole classes of clients, but approach it on a case-by-case basis. And if you read into that paragraph, the second one, for example, it says, it only requires institutions to terminate relationships on a case-by-case basis where the money laundering and terrorist financial risk cannot be mitigated. And there's a word again, mitigation. You exit if you cannot mitigate. But if you can report your suspicions, is that enough to do mitigation or not, right? If you report, are you still worried that you let that bad business go, right? You let it happen despite reporting. So and so maybe what these French-speaking banks had taken to is a sensible approach, right? To at least understand before a transaction's happening, so that they at least have a choice in the matter to see if they want to let it go or avoid the risk on behalf of their prudential regulator. So another use case that we've heard over the years from our clients is, sure, we'd love to detect in real time so that we get alerted straight away, because that makes it easier to investigate stuff. So someone walks into a branch and deposits a bunch of cash, right, that the system flags as unusual, perhaps suspicious. If you alert that straight away, it's easier for the folks in the compliance team to, for example, call that branch or call the relationship manager of the private banking client straight away to see what the situation is, instead of only being alerted the next day or the day after that, where the client is long gone, the staff member that talked to him and accepted the money is on vacation or out of office, right? So if you can know in real time, it's kind of useful to know in real time. It makes you more effective and arguably efficient in investigating those situations to arrive at a conclusion to either close the alert or escalate it to a case or SAR or STR. And yet another one is a slight detour into the world of sanction screening, which of course primarily has been a business of screening customers and transactions against watch lists, right, such as OFAC or the UN list or the EU list, etc. And as we've obviously seen in recent years, that is not a perfect solution to the problem, right? Things get missed or messages get altered so that things get missed. And so it's not a perfect science. And when you see why the fines happen, it's not because a system missed a name on the watch list. It tends to be because there were large money flows and the bank should have seen those and should have known that those were strange, right? So it would really make sense to complement name screening with the ability to understand the money flows that go through your bank on a global level, for example, in the correspondent banking business. And because the prevailing paradigm in sanctions is to prevent them because violating sanctions is illegal, that kind of monitoring should also happen in real time, right? That if you see transactions go by repeatedly that maybe involve oil money and go to a bank in a country neighboring on Iran, you probably want to be in a position to stop it, even though there's no name in that transaction that's on a sanction, or country even, that's on a sanction list anywhere, right? So if you're able to understand that sort of stuff happening before it gets executed, you're in a better position to catch potential sanctions violations through other means. Now, towards this end, regulations already call for an additional real-time requirement, and that is to screen for data that's missing in wire transfers, right? If you just focus on the bottom section there, number 14. You should not be allowed to execute the wire transfer if you're the ordering financial institution if it doesn't contain the accurate origin or the complete and accurate originator and beneficiary information, right? So that's also a real-time requirement, at least in my definition of real-time, which is as quick as you can in time to do something about it, okay? So those were all sort of use cases as I collected them, if you will, from our client base and our experiences over many years in many countries around the world that sort of live within the current regulatory constructs and paradigms, right? And again, I think the one where the institutions have to juggle between the policy objectives of their FIU and the ones of their, for example, central bank are the most interesting and challenging ones. Now, if you are to do real-time detection for AML purposes as and where you can or you think you need to, what are some of the things that you should keep in mind? Well, the first one is perhaps a little bit obvious. Does this type of payment or transaction channel give you any time to make up your mind, right? So if it's, for example, deciding on a large letter of credit, that probably takes a few days, right? So you have some time to think about it before saying yes or no to that client versus, large credit card transactions, a guy standing in a store somewhere buying a large TV, where the system almost needs to make a spot decision. So it kind of only makes sense in situations where there is time for someone to look at it for quite a bit of time, right? And that's just a different world than, for example, in the fraud space, where fraud is pretty cut and dried, and it might just take a call to the customer to say, hey, is that you that was just buying this TV over in Indonesia? And if he says no, then it's fraud, and you can stop it. So that's something to keep in mind in where and how you would apply this technological capability of real-time detection, right? On that technology front, is that system also able to learn in real time? Giving an answer to a question straight away is one thing, right? And perhaps even your core banking system can do that, but is the system also able to digest those events in real time and update the behavioral profiles that it has for that account or that client or that card? You recall the examples I gave earlier on where the person would go from branch to branch, either to put cash on his prepaid card or to try and get a loan with made-up stories. In both of those cases, it's important that the system updates its knowledge about that client straight away so that by the time he makes it to the next branch, we can answer that question with that knowledge of that first instance in mind. And as things get quicker and faster, that becomes more and more important, right? That it learns as things happen. The other thing to start thinking about, if you do start pursuing a real-time detection paradigm, regardless of whether or not you want to do something about it, right? Regardless of whether or not you want to prevent transactions from happening if you think they're suspicious, but if you subject those transactions to real-time scrutiny, can you start thinking about almost a one-stop shop, right? Where there's a single engine or system that evaluates transactions as they happen to help you oblige with your sanction screening obligation, to help you with fraud prevention, as well as look for money laundering patterns that may give you time to do something about it, right? Investigate straight away, stop it if you want to, or whatever the case may be. Does it make sense to have such a one-stop shop at some point? And then the other question that is probably top of mind with regulators is, if you
were to reject transaction because you don't want to take the risk in regards to your prudential regulator, for example, how do you say no politely, I guess, without tipping off, right? This holy principle in most AML regulations that you shall not tell a customer that they might get reported on to their regulator. So how do you say, well, we thought about it, but we're not gonna approve this real estate investment. We're not gonna take care of this real estate investment for you. How do you do that without making it clear that you're doing so because you're gonna file a SAR on them to the regulator? So with that, a couple of parting thoughts of whether or not, as an industry, we can or should consider a wholesale shift in approach along the lines of what Latvia has done to just make it clear that we're on to them, right? And take the bad guys head on. So the first thought there is that, well, ever since I joined this industry almost a decade ago now, the magical number that's always sung around our industry is that money laundering globally constitutes about 2 to 5% of annual global GDP, right? So trillions of dollars. I don't even remember what the research source was that came out with that number, but it's this famous number that's always been around. And I guess since tax evasion became a predicate offense to money laundering as well, that number may have gone higher. But the point I want to make with it is, what is this number today, right? After our decades of effort and the millions and millions of dollars that we all spend on this AML industry of ours, where we file our CTRs and we monitor our clients and we file our SARs and we do all this KYC, is that doing something about that 2 to 5% of annual global GDP? And would that be different if we were to take a different approach to it and just, as a financial industry at least, stop them at the front door if we think it's suspicious? Or even existing clients, when you think their behavior is suspicious, to just say, sorry, sir, we're not going to perform those transactions for you. Would that be different in outcome than our current policies? Okay. Related to that is, we've been at this for a few decades, and we're not very quiet about it, are we? Right? AML is a famous domain and a famous industry with high-profile cases and enforcement actions, and it's no longer a secret to the criminals that we're trying to catch them. Right? It's this cat and mouse game where they know a lot of our policies and a lot of our principles and a lot of our systems and the ways we try and catch them. So it's not as if we're sort of pretending that we're just banks going about our business and letting them do their thing. All right, they know that we're trying to report on them if we think it's suspicious, right? And maybe that's not deterring them today. And so one could wonder what would happen if you just do what Latvia does and say, we're on to you, buddy. We're not going to do it. One of the arguments that's always lived against that sort of approach is the concern that would drive all of that criminal finance underground. On a smaller scale, we saw that around this whole de-risking issue, where the concerns were that if the large banks stop doing business for certain types of clients, those legitimate clients would have to seek refuge almost with smaller institutions who may not have the same resources that the larger ones do to effectively mitigate the risks of those higher risk clients through their AML program. But on a larger scale, if all of us would take the Latvia approach, for example, what would happen, right? How do you drive 2 to 5% of annual global GDP out of the legitimate financial industry altogether? What would replace it? Bitcoin, I don't think, is quite ready to take so much money on. And so what would happen? I don't have an answer to it, but I always felt it was sort of a very quick argument to just say, oh gee, then it would drive criminal finance underground. And last, but certainly not least, is cost versus benefit. It would probably worth looking at the cost versus the benefit of how we've approached things to date, right? All the money we all spend as an industry to comply with the regulations as they exist today versus the benefit as a society we get out of it through the successful law enforcement investigations that are aided by our efforts. And the other cost versus benefit equation that you could try and make is what would be the cost for the industry to move to real-time understanding so that you're in a position to say no to transactions that you think are suspicious. What would be the cost of such an approach, and would that lead to a materially larger benefit than the ones we get from today's approach? Took a look at a recent, probably 2 years old document by the Wolfsburg Group, right? This group of large banks that get together to think about AML and other financial crime regulations, and they still clearly define their world or the world they recommend as transaction monitoring being something that should happen after transactions are executed, clearly within today's paradigm to just observe and report, right, as it says here in this bottom paragraph. So I don't have an answer, and if you were hoping for one, I apologize. But I do think it's a worthy debate to think about, and at least in some places think about using the technological capability of real-time detection that's become so prevalent in other financial crime domains to do a better job and mitigate your own risks as an institution. So, in summary and conclusion, the technology does indeed exist, obviously, right? Real-time detection engines have been around for a number of years, and it probably won't come as a surprise that we have such capabilities as well through some of the examples that I gave earlier about, for example, the prepaid card processor and their branches, their outlets. As I hopefully showed, valid use cases do exist today within the current environment where it just makes sense in line with what regulations expect from you to detect stuff in real time. But in order for a drastic change in leveraging that technology to just wholesale change the way we do things, that of course is a massive discussion where I don't pretend to be smarter than the FATF and other bodies of very smart people that have arrived at the policies that exist today. So that, I think, is my presentation. If you, there's some time left, so I'll read through the questions that have come in and try and answer the ones that I can. If you do have questions or comments or observations that you want to share with me offline, whether about our technology, but also just talking shop in AML land, financial crime land for that matter, feel free to reach out to me. And with that, I will start scanning the questions to see if I can answer. How much information of suspicious individuals can be shared between different banks versus within a single network? That's an interesting question, and it starts with, let me start that answer with within a single network, by which I think the person means a bank with a number of locations, for example. What we've seen with such deployments, right, where we have a global bank or a regional bank that uses our software across a number of installation countries and business units, is that as a rule, information about reported individuals or really suspicious individuals should flow up to central compliance and be disseminated back down into the business units. Because if you reject a money launderer at your branch in Hong Kong, they should not be able to fly over to Singapore and still open an account with the Bank of Singapore, who then doesn't know within the same bank about that person being rejected in Hong Kong. So that's sort of the overall policy. There can be, depending on the country and the situation, exceptions to that where privacy regulations, money laundering regulations prevent that from happening, right? So the overall structure needs to be there. There can be exceptions that central compliance needs to think about, for example. The other part of the question is between different banks, and that's where regulations are quite tricky. As a rule, I think you're not allowed to share with different banks. In the U.S., there is some specific language which I don't have ready at the top of my mind about under what circumstances you can share information either with law enforcement, but I think also with other banks. So there is some capability there, but as a rule, it's much harder than, for example, in the fraud space, where there are industry lists of fraudsters, for example, insurance fraud, for example. The most probable reason is that fraud is pretty cut and dry. It was fraud, and so the person gets convicted of fraud, and that's it. Money laundering, as far as banks are concerned, mostly deals in suspicions, right? So you suspect someone who might otherwise be a respected member of society of money laundering, and sharing those thoughts with other banks just like that probably violates a lot of rules. Two separate questions: filing an SCR or a SAR. Well, those are two different terms for the same thing, right? In the U.S., the document is called a suspicious activity report. In many other countries, it's called a suspicious transaction report. So the terms are pretty much synonymous, but may require, most all require different file formats depending on the jurisdiction that you're in. Being unable to complete CDD measures, missing info / unable to identify, would that not be considered suspicious in its own right? It might. Maybe the client, let's say you're onboarding, right? Let's say you're not able to find a public source where you can verify information in a difficult country, for example, right? Or the client struggles to deliver that information in a timely manner. That might be bona fide, right? It might be a startup business that doesn't have all their stuff together yet. So it doesn't have to be suspicious if you're unable to complete CDD. I think the principle of the regulations is don't do it unless you are able to complete CDD. So hopefully that answers that question. Scanning through here. My bank as a correspondent bank with a U.S.-based bank, can I get the penalties from the U.S. in case of suspicious money laundering? I think the answer is yes. I think we've seen that in the past. And doesn't matter if the transaction is not in U.S. dollars. That's a question that I don't have a ready-made answer for. I think we've seen that the arm of the U.S. regulator and law enforcement is pretty long, and they carry a pretty big stick. So just doing business in another currency might not shield you, but that's for others to judge. How do you think real-time AML investigation will work with the increased use of mobile technologies? Well, a couple of parts to it. If you're talking about the growth in mobile banking and payment products, it arguably becomes even more important, right? Because money moves so much faster and is so much more global. Think of international mobile remittance and having mobile wallets from banking to the unbanked, and then how do you figure out how much of that, how many cell phones does one guy have on which he receives the deposits from back in the U.S., and can you investigate that quickly as well? So for sure, with the advent of mobile, money moves faster. It's technologically more advanced, so it lends itself better to enabling real-time detection. And arguably, it also becomes more important for AML, but especially also for terrorist financing, for example, because the money can move so fast. How do you track it and understand it? When you are dealing, I don't understand that question. I have to skip it. Can you go over the example again of putting branches on alert for bad loans deposit? What exactly you mentioned there? What I mentioned there is that this bank has experience with probable money launderers who try to abuse their institution to launder money, either to make large deposits into accounts and perhaps ask those deposits to then be wired somewhere, or to ask for a loan, which they would then later repay with bad money, right? And with that loan, they're able to buy their speedboats or their houses or what have you as legitimate money. And what would happen is that this guy would try and do that with a fabricated story that the teller at the branch doesn't trust, and so he sends that person away, only for that person to get into his car, drive 2 streets down to the next branch, and walk in there again with that same amount of money into the same account or the same request for a loan from the same guy, only with a different story, right? And the risk that compliance department sees is that it's great that the teller at branch number 1 was vigilant enough to see through the story, and maybe number 2, but maybe the third one is not as vigilant or receives a better story. And so what they would like is the ability for that person at the first branch to just enter a couple of things into a system, which then gets promulgated to all the branches so that they're all put on alert, so that they enter, Mr. Decker, and you want to have a loan for $300,000. It immediately flags, wait a minute, that same request just happened at the first branch, and so you shouldn't allow it because it's a fabricated story. Hopefully that explains that example once more. 4 more minutes. In addition to fraud, money laundering, what about adding human trafficking and smuggling? Yes, those are also terrible crimes, typically seen as predicate offenses to money laundering. And so in the last couple of years, there has been more attention to those particular terrible crimes. And there are things you can look for to spot it, depending on your country and the industries that your clients are in. So I think, for example, about regions in the U.S. that are close to the Mexico border, I think there's examples there of certain types of stores and shops, right, nail salons, those kinds of things, where that increases the likelihood of it involving human trafficking, smuggling. So absolutely, right? It's important, and I don't really have an opinion on whether there's anything specific to it that calls for real time as opposed to money laundering for other predicate offenses, income. Other than financial institutions, how are public and private businesses contributing to help detect money laundering patterns? Well, obviously, if by financial institutions you mean banks, credit unions, insurance companies, and the like, AML regulations, of course, cover a lot of other professions and industries, right, ranging from from car dealerships and casinos to lawyers and notaries and the like. In general, what we're seeing increasingly actually is that companies like corporates have a need and a desire to subject for example, their vendors and employees to sanction screening, for example, right? So not money laundering per se, but more sanctions and terrorist financing. So how do they help detect? In different ways, either willingly or not, right? It also depends on the sophistication of your country and your government, for example, and how much information is automatically fed into tax systems and those kinds of things. Can real-time payment screening be successfully applied to general insurance? Depends on your definition of general insurance, but I think the answer is yes. We've done that a few times, and where you can, for example, start spotting patterns of a claimant getting pill subscriptions from a number of pharmacies, or a doctor claiming too many working hours in one day, and those kinds of things. So that stuff can happen before the payments come out. You can also do things like real-time scoring of claims information. As you get information about the claim, the score gets adjusted in real time, so that the moment you say it's good enough, you pay it, and the moment you say it's suspicious, you stop it. So yes, there are examples there as well. And with that, I think I haven't been able to get through all the questions, but we're at the top of the hour. So with that, I will conclude this webinar as far as I'm concerned, and thank you all for your attention. I hope it was interesting, and hope to hear from you. Thank you, and bye-bye.
And thank you. I think it was very thought-provoking, and the fact that you had so many questions indicates indeed how well you connected with the audience. While you're thinking about it, consider